When it comes to your retirement, do you want to have the same old plan everyone else has? Of course not. You're unique and have your own goals and dreams. Don't be treated just like a number. This is your retirement. So it's time to think differently. And you're in luck because you've found the Retire Your Way podcast with ILG Financial. At ILG Financial, you won't find generic, run-of-the-mill plans containing the same old cookie-cutter solutions. Dave, Chase, and the ILG Financial team focus on building one retirement at a time using their Think Differently philosophy. And that means your own comprehensive plan with customized solutions built to achieve just one goal, yours. So put on your Think Differently hats and get ready to take back control of your retirement today and for all the tomorrows to come. ILG Financial's Retire Your Way podcast was created just for you, and it's starting right now.
When it comes to retirement, do you want to have the same old plan everybody else has? Of course not. You're unique. You have your own goals and dreams. Don't be treated just like a number. This is your retirement, so it's time to think differently. And you're in luck today because you found the Retire Your Way podcast with ILG Financial. At ILG Financial, you won't find generic run-of-the-mill plans containing the same old cookie-cutter solutions. Dave and Chase and the ILG Financial team focus on building one retirement at a time using their Think Differently philosophy. That means your own comprehensive plan with sorry about that. With customized solutions built to achieve just one goal, yours. Put on your Think Differently hat and get ready to take back control of your retirement today and for all the tomorrows to come. ILG Financial's Retire Your Way podcast was created just for you, and it's starting right now. I'm Ron Stutz along with Chase Lopez today, ILG Financial, and we're going to talk about gold today, which is really a popular topic for a lot of people. And Chase, I know you got a lot of questions from folks, clients and non-clients about gold, its value, and how they should treat it. So I'm really looking forward to today's conversation.
I don't think you can go without, when you're watching TV, without seeing, some sort of commercial about gold. So hopefully we'll be able to get some information out there for folks that they can lean on.
Exactly. According to Goldman Sachs, in January of this year, gold is one of the least effective inflation hedges. And this may be real news to some folks out there, but this is information that may differ from what you've already either heard or believed in the past when it comes to your investments, especially when trying to protect yourself against inflation. Today, we're going to talk with Chase Lopez about this idea, what it means, and the place it holds in your retirement plans. He will also tell us what we could look at in gold's place moving forward. So, Chase, glad to be with you here today. I am as curious as anyone what you're going to say about gold, and let's see where this conversation goes. What do you think about all this?
Yeah, so first of all, great to be here again with you, Ron. The podcast is one of my favorite mediums to kind of get out there and, talk about these things to the listeners. Mm-hmm. But, as you kind of alluded to, gold is a popular inflation hedge amongst investors. But we're finding it's not as effective as it may have been in the past. And there's a couple of reasons for that. But to your original point, it's very much in the, in the lexicon, right? A lot of people are kind of talking about it. A lot of people over the past few years, I should say, have discussed commodities and Bitcoin as kind of a replacement for gold. Right. So we'll get a little bit into that as well. But we also have other videos, YouTube channel, and other podcasts where we discuss how those don't necessarily provide protection against either. But today we're going to, specifically zero in on that gold investment just because it's very popular, as I kind of mentioned before.
Now, gold has been a popular inflation hedge among investors for a long time. But I'm hearing you say, basically, that these days it is not actually always effective.
Yeah, so, and I think 2024 and 2025, which is where we're at right now, as of this taping, over the past year, gold has gone up by about 27%, which on its face sounds like, hey, that worked out great, right? So that's why it's becoming very popular again to kind of talk about gold, because over the last year or so, gold has had a big run, and it's long been regarded as kind of a tangible store of value, right? And an inflation hedge. But this isn't necessarily true. Many point to gold's historical performance for its future success. So with your permission, Ron, what I'm going to kind of do is kind of walk through that performance just so that can give, the listeners a little bit of context on if these returns are actually, or if this performance is actually something that they want to incorporate into their portfolio.
Okay, so how did gold perform in 2024?
Yeah, so in 2024, actually, gold beat the S&P 500 by about 2%. So just for the listeners out there, the S&P 500, that's just 500 of the biggest U.S. publicly traded companies, right? So it's very much considered kind of the bellwether of the stock market, right? When people talk about the stock market, oftentimes they're talking about the S&P 500. So gold did beat the S&P 500 in 2022 by 2%. But if you take a step back and you look at more longer term performance, at the end of 2024, the price of gold was $2,625 per ounce, and that reflected an average of 3.6% rate of return each year in the price of gold since 1980. So basically, it's averaged 3.6% a year since 1980.
Yeah.
If you compare that to the market, right, the stock market, the S&P 500, over that time, the S&P 500 has averaged 11.7%. So you can see the disparity there as far as returns over the long term between gold and the stock market in general.
Boy, that is a big difference for sure. And what about other commodities during that period of time?
Yeah, so it's a great question, right? Because oftentimes when people think of an inflation hedge, they think of gold, right? That's kind of the first thing to come to mind. But also folks think of things like, to your point, commodities. So oil and gas is a great example. So over since 2010, the total returns for oil, we're not talking about oil stocks, but we're talking about the price of oil, total return since 2010 has actually been negative. So oil prices are no higher than, where they were going back, 15 years or so. Mm-hmm. On top of that, the commodity market is subject to a lot of different variables, right? So when people think, hey, I'm going to use the commodity as an inflation hedge, you have to remember with a lot of these things, there's a lot of different variables that are making the prices move. So, with oil specifically, we have geopolitical things with the Middle East and things like that can affect the price of oil. And that has nothing to do with inflation, right?
Yeah. Yeah.
So you got to just make sure that when you're looking at things, it's not always so binary, right? Hey, inflation up should be up. There's a whole other host of variables that can affect the price of something that you just need to take into consideration.
So it looks like for investors looking to beat inflation, there's so many things that are beyond your control when it comes to commodities. It's not always a good idea to put your money on commodities. But what about, I can just imagine a lot of people right now listening to this are saying, well, Chase, what about Bitcoin? What do you say about Bitcoin as a hedge against rising deficits and inflation?
Yeah, so you're exactly right, Ron. I would say when we have this inflation conversation with clients or prospective clients, when we're talking about inflation, the two things that they talk about are gold and Bitcoin, right? Mm-hmm. Those are the two biggies. And Bitcoin has been advertised or talked about like digital gold. I don't know if you've heard that term before, but a lot of folks call it digital gold, right? The reality is with Bitcoin is much like gold, it's very much what they call a speculative asset, right? And we talked a little bit about this, Ron, before we hopped on the podcast. But really, when you're buying Bitcoin or you're buying gold, what you're doing is you're buying it for a price today, and you're assuming that you're going to be able to sell it someday down the line, someday in the future. You're assuming you're going to be able to sell it to somebody else at a greater price, right? And that greater price really has nothing to do with cash flows. It has nothing to do with a business growing, right? For example, it has everything to do with the fact that, hey, I'm just assuming that the price is going to be higher in the future. So it's very speculative in that way. And it can also be very volatile, right? And if folks have followed Bitcoin, it can be up a lot. It can also be down a lot, right? So that's something that, a lot of people need to take into consideration. And then the last thing with Bitcoin is we just don't have a very long track record with it, right? Bitcoin has been around 2008 is when it started. But really, it hasn't become kind of mainstream, right, like it is today. really it became mainstream over the last, I would say, 5 to 10 years. So we just have a very limited history with that. So it's very hard to say, hey, Bitcoin 1-for-1 is an inflation hedge, just because we don't have that much data to support that.
Yeah, wow. Not a whole lot to go on there. So
Right.
cryptocurrencies, even though it's a main topic of conversation with a lot of folks these days, does not sound like something that is really reliable as far as guarding against inflation in the future. Again, Dave Lopez and Chase Lopez have some other episodes where they go more into depth on Bitcoin and cryptocurrency and the details of how they work and why they may or may not be a good investment for your portfolio. So, Chase, what can people potentially replace their commodity investments with in order to protect themselves from inflation?
Yeah, so I think the point that you made there, Ron, is a good one. By no means are we sitting here on the podcast and telling you, hey, you should not invest in gold, or you should not invest in commodities, or you should not invest in Bitcoin or cryptocurrencies, right? There's a place for everything in someone's plan, in someone's portfolio. Really what the whole goal of the podcast today is just to get people to start thinking, hey, what you thought these investments were being used for, inflation hedge as one, right? Maybe they aren't the best way to achieve that goal, right? Mm-hmm. So, I know we sound like a broken record on the podcast. Whenever you're speaking about your specific investment portfolio and how it fits your plan, you definitely want to get with your advisor to make sure, hey, if we're doing this, right, if we're buying gold or whatever the case may be, why are we doing it? What's the goal of doing this? And have them be able to articulate that to you.
This gives me an opportunity to say what we have said 1,000 times before. Everybody's situation is different. Financial planning is based on individual needs and individual wants and desires. There is no one size fits all when it comes to financial planning. Chase and Dave Lopez can explain that to you every single time you talk to them. But, there are some folks who just keep forgetting that. Like, there's a generic plan that's going to work because it worked for my neighbor or my brother-in-law or whatever. But that is not the case.
Absolutely. Absolutely. So I want to circle back on your question, right? Which is, hey, if gold or commodities or Bitcoin aren't the best fit, right? What are some things that can help folks hedge against inflation?
Okay.
And one of the biggest ones actually is the stock market. So U.S. equities is what they call it in our industry, right?
Right.
So all that means is, and we won't do a whole deep dive into what a stock is, right? But moral of the story is, if you own, say, Apple stock or a stock in any company, you are part owner in that company. Now, a very small part owner, right? But nonetheless, you are a owner in that company. So as that company starts to grow, right? As they start to, as their business starts to do well, as they grow sales, grow revenue, grow profits, you as a stockholder are able to participate in that, right? So right. With that said, with high quality companies, right, with companies that do have a good management team and have a good business that they're in, oftentimes when there's inflation, they're able to pass those prices onto their consumers, right? So I think, the last 3 years, it couldn't be a better example. When inflation was going up, if you went to the grocery, and this was a common complaint, right? If you went to the grocery store, if you went to Target, to get socks or whatever the case may be, right?
Yeah.
Everything was more expensive, right? Those big companies were able to pass on those increased costs onto the customers, which stinks if you're buying the stuff, right? But as a shareholder in that company, you're able to participate in those increased sales and things like that. So that's why U.S. equities is one way to kind of hedge against that inflation if it does crop up.
Yeah. What about real estate? A lot of people invest in real estate, and what are your thoughts on that as a hedge against inflation?
Yeah. So real estate's actually one of the best inflation hedges out there. And again, I think we're doing this podcast at a very, very good time, right? When we're talking about this stuff, because if we go back a couple of years, everyone remembers housing prices just going through the roof. I don't know if it was the same with where you're around or where you're at, Ron, but at least around here, housing prices just went through the roof around COVID and shortly thereafter. Mm-hmm.
Yeah.
Yep. So the reason why real estate works as such a good inflation hedge, right, is Two reasons. The first is there's a finite amount of real estate, just in general, right? The United States isn't adding on, any land onto the east coast or the west coast, right? There's only
That's right.
There's only a certain amount of land available, right? And land that's buildable at that, right? That you can put a house on or something like that. So as inflation starts to kick up, what that allows on the commercial and on the residential side, if we're talking about rentals, right, it gives the landlord the ability to raise the rent, right, which then makes the property more valuable. So real estate is a great inflation hedge, right? That's oftentimes why folks end up buying their home as opposed to not, right, because they can they participate in the fact that their house is going up in value. So definitely something that you want to talk to your financial advisor about having, real estate in your overall plan. Right.
Yeah, property values tend to rise right there alongside inflation. There's no
That's right.
question about that. Also, labor and materials costs go up, and that can be a negative when it comes to, real estate. But what are your thoughts on that?
Yeah. So when labor costs and material costs go up, right? Typically, those extra costs, just like we were talking about with the stocks, right? Typically, with those costs get passed on to the eventual consumer. In this scenario, right, it's the person that buys the house, right? So if the labor costs were more and the material costs were more to build the house, well, then in turn, the person that's buying the house would have to take on those costs. And the reason, and it kind of goes back to our original point, which is the reason is there's a fine houses out there for folks to buy, right? This wouldn't necessarily be the case if there was some sort of way where we could infinitely just continue to build houses everywhere, right? And we had an infinite amount of land. Yeah. Well, then that wouldn't be the case, right? But because there's a finite amount, that ends up being the case that with material costs going up or with labor costs going up, the person buying, the consumer, is the one that has to kind of pay the brunt of that.
Here we are on the Retire Your Way podcast today with Chase Lopez, and I'm going to tell you how you can get in touch with Chase and the other folks at ILG Financial in just a moment here. But we're talking about inflation and gold and the stock market and all kinds of things, real estate. What about intermediate treasuries? What are they? Explain that if you would, and give us some examples, Chase.
Yeah, so intermediate treasuries, right? The name there, we'll kind of break it down into each of the words. So intermediate, what we mean by intermediate is when those treasuries mature, right? So typically it's anywhere between 2 years and 10 years, right? So it's a short-term treasury would be less than 2 years, and a long-term treasury would be more than 10 years, right? Mm-hmm. So the intermediate is kind of that middle area there. And oftentimes, and so that's the first part, the intermediate part. The second part, treasuries, right? That's just a bond issued by the United States government, right? So if the government needs to raise money, the federal government that is, which they often need to raise a lot of.
And they do now.
Yes. So when they borrow money, right, they borrow it by issuing bonds, and those bonds are called U.S. Treasuries. That's what they call them. So oftentimes those intermediate treasuries, especially right now with bond yields creeping up here over the past 6 months or so, meaning the interest paid by these treasuries has gone up. This can be a good hedge against inflation for two reasons. One, the interest that you're receiving can offset some of that inflation that you see. And then secondly, with the bonds being issued by the U.S. government, there's very, very, very little risk of default, right? There's very little risk that the U.S. won't pay those treasuries back. So it works two ways for you, and it's a little bit more of a conservative way to hedge against inflation if you don't want to be in the stock market or if you don't want to be in real estate.
Yeah. Wow. There's so many things to think about here, and we're all concerned about inflation in the future because we've seen what inflation can do. Mm-hmm. And, if you're concerned about building some kind of a protection for yourself against inflation, putting barriers between your wealth and all these things that are happening out there, I would suggest you have a conversation with Dave Lopez or Chase Lopez at ILG Financial. And Chase, let me just ask you a generic question here. I used that word generic just a few minutes ago, but let me ask you a question here. When somebody calls ILG Financial and they want to have a conversation with you, what does that very first conversation look like? What do you talk about?
Yeah, so really in that first discussion, we call it really just a discovery meeting, right? So we're just going to talk about where you are right now, talk about more importantly, I guess I should say, where you want to go, right? Hey, I want to retire in 5 years, or I want to pay for my daughter's wedding in 3 years, or, everyone has their own specific goals. They also have, a specific amount that they've saved for that, a specific, income level that they're at. So what we can kind of do is start to fill in those pieces to the puzzle for folks. But that first initial meeting is really just figuring out, hey, where are you at and where do you want to go? And we'll talk about, in future meetings, how we can get you there.
Well, I think that, there are lots of reasons for giving your office a call. And it's, very apparent that we all need to think about inflation. Some people, it's amazing, don't even consider inflation when it comes to planning for the future,
Right.
But certainly at ILG Financial you do. You can call 540-720-5656. That is 540-720-5656. And you can have a conversation with Dave Lopez or Chase Lopez at ILG Financial. And I hope you can find out more by going to ilgfinancial.com, ilgfinancial.com. Well, you're one step closer after our conversation today to learning what a customized retirement strategy can do for you. Income, legacy, growth, it's all right here at ILG Financial. And it's about helping you plan for retirement your way so you can achieve your financial goals. Call ILG Financial today at 540-720-5656 or go online to ilgfinancial.com to find out more. Chase, it's been my pleasure to hang out with you today. I learned a little bit, and so will everybody out there who listens to this podcast, and I'll look forward to talking with you again next time.
Absolutely. Thanks, Ron. Really appreciate it.
The Retire Your Way podcast from ILG Financial. Thank you so much for being with us today. The information provided is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. The views presented today are those of Dave Lopez and do not necessarily represent the views of the Alpha Star Capital Management, LLC. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Investment advisory services offered through Alpha Star Capital Management, LLC, a registered investment advisor. Alpha Star and ILG Financial, LLC are independent entities. SEC registration does not constitute an endorsement of the firm by the Commission, nor does it indicate that the advisor has attained a particular level of skill or ability.